The basis and the holding period of an asset. This is kind of the foundation of everything having to do with property, because it's what is our cost, what is our basis in the asset, and how long is it that we are considered to have held that asset. And this is the foundation for what we're going to have as a gain or a loss when we dispose of the asset. And so what we're going to see here is that we've got different situations about how an asset is acquired. We've got three ways that we're going to look at. We can acquire an asset by purchasing it, we can acquire an asset as a gift, or we can acquire an asset by inheritance. But for all these situations, no matter how it is that the asset is acquired, what we need to know is what the basis of the asset is for us and what the holding period of the asset is for us. So we're going to start with this. We're going to look at each of these three situations and go over what the basis of the asset is and what the holding period is going to be for that asset. And we start with the simplest. Okay? We start with when we acquire an asset by purchasing it. And the basis that we have for tax purposes is calculated essentially the same way as it is for financial accounting purposes, in that the basis is all of the amounts that are paid for the property, all of the costs that are necessary to prepare the asset to be placed into service. So it's the property itself, it's any incidental expenses that are paid, recording fees, appraisal fees, installation costs, whatever it is that is necessary to get that asset into service to be used. Now, when we say the amount paid, it doesn't necessarily mean only cash. It could be other property. It could be services that we provided. It could be that the purchaser assumes some liabilities. Okay, so whatever it is in terms of what it is that we gave up in order to acquire this asset. Okay, now that's the basis, and we'll see a simple example of that. The holding period of the asset begins when we acquire the property, and that seems perfectly reasonable. If you purchase it, that's when your holding period needs to begin. Now, simple example, Bill bought a house. Bill paid $200,000 cash, and as part of the transaction provided services for the benefit of the seller of the house worth $30,000. Bill also had to pay recording fees of $1,000 connected to the purchase of the home. Okay? That's everything that Bill gave up. So Bill's basis in the house is $231,000. The cash, the services, and the recording fees becomes the basis for Bill in that house. Okay, that's acquisition by purchase. The second situation we have to look at is the acquisition by gift. Somebody gives us the property. We have the same two questions. What is the basis in the property, and what is the holding period for that property? So we're going to look at this in the situation of gift. Now, for gifted property, the basis, okay, our basis in the property is going to depend on the character of the property that was received as the gift. And the two categories of property are appreciated property and depreciated property. And so to know whether it's appreciated or depreciated, we need to know the donor, the giver's adjusted basis, and the fair market value of that gifted property. If the fair market value is greater than the donor's adjusted basis, that's appreciated property. If the fair market value is less than the donor's adjusted basis, that is depreciated property. So we'll start by looking at a gift of appreciated property, where we've received something that has gone up in value while the donor, the giver, has held it. So our basis in appreciated property is calculated as the donor's adjusted basis plus some of the gift taxes paid by the donor if the donor had to pay gift taxes. Those two numbers make up our basis in the property, the recipient's basis in the property. And then this basis is what's going to be used to calculate the gain or loss when we sell the property, if we ever sell it. Now, we'll come back to the gift taxes part in just a minute. It has to be a large gift in order for there to be any gift taxes that were paid by the donor. But what's essentially happening in the situation where the donor's adjusted basis is becoming our adjusted basis is that the gain on their holding of the property, they bought it for $1,000 and it's now worth $3,000. Okay, that gain, they're not paying taxes on it. The taxes on that are being deferred until the recipient sells the property. Okay, the giver paid $1,000, they gave it away when it was worth $3,000. There's a $2,000 gain there, but because the giver didn't sell the property, they gave it away, they don't have any money to pay the tax with. Even if they wanted to pay the tax, they couldn't because they didn't sell it. They didn't actually capitalize, get the cash from that appreciated value. So we get their basis. We have in that property a basis of $1,000. So when we sell it, we're going to get to pay the taxes on the increase in the value while they held it, plus the increase in the value while we held that property. It's just the way it is. Okay, so we've got this appreciated property, the donor's adjusted basis, plus some of the gift taxes. Now, the way we calculate the amount of the gift tax to include, we've got a nice little formula here. We take the gift tax that was paid, and it's multiplied by the fair market value at the time of the gift minus their basis, which is their increase while they held the asset, divided by the amount of the gift after the gift exclusion. The gift exclusion is $15,000. Okay? You can give a gift to anybody and everybody, $15,000 or less, with no gift tax implications. So this amount of the gift after the gift exclusion is, what is the amount of the gift in excess of $15,000? What is the amount of the gift that could have a gift tax on it? Okay? That ratio multiplied by the gift tax paid is how much of that gift tax goes into our basis. And we'll look at this with numbers. Okay? We'll do an example that has numbers. But first, an example without numbers. Or I'm sorry, with numbers but no gift tax. Aunt Martha gave a necklace to her niece. The necklace had cost Aunt Martha $100, and at the time of the gift, the necklace had a fair market value of $150. Because the fair market value of the necklace was larger than the donor's basis in the property, for the recipient, for the niece, their basis is going to be the donor's basis in the property plus any gift taxes paid, and in this case it's zero. It's well below $15,000. So Aunt Martha bought it for $100, gave it away when it had a fair market value of $150. The niece takes that necklace, says, "Thank you very much, Aunt Martha." And for the niece, the basis is $100. If the niece sells it for $150 right now, she has a $50 gain. If she sells it for $175, she has a $75 gain. Okay, that $100 is the niece's basis in the property, and that's what's going to be used to calculate the gain or the loss when the niece sells that necklace. If the niece never sells that necklace, then there's no gain ever going to be realized on it. Okay, because it's not being sold. Okay, the second example we look at has the gift tax element to it. 2018, you received a gift of property from your mother that had a fair market value of $50,000. Her adjusted basis was $20,000, and she paid a gift tax of $7,100. Well, if the fair market value is $50, the adjusted basis is $20, there was a $30,000 increase in the value of that property while your mother held it. She's giving it to you. Okay? So what we need to do is we know that our basis in the property is going to be her basis, $20,000, plus some amount of the gift tax. So we need to calculate what amount of that gift tax goes into our basis. So formula for that, the gift tax paid was $7,100. We multiply that by that ratio, which is the increase in the value, $30,000, divided by that amount of the gift in excess of the $15,000 gift exclusion, so $35,000. So 86% of the gift tax is added to our basis in the property. So $6,106, add that to the $20,000 adjusted basis, and our basis in the property is going to be $26,106. Our mother's $20,000 adjusted basis plus a percentage, a part of the gift tax that she paid. Now, that's the gift of appreciated property, where the property went up in value while it was held by the person who gave it to us. We now turn our attention to the gift of depreciated property. And depreciated property is, they held it, it went down in value, and our basis in that property is not known immediately. We're not going to be able to calculate our basis in the property until the recipient later disposes of the property. And we've got a table here, and we're going to look at the table, then we're going to look at an example and put numbers to it. I think when we first look at this table, it sounds kind of excessively involved. But after we look at it and go through the example, I think you'll see that it actually kind of is perfectly reasonable and not as bad as it seems at first. So here's our table. If, when the recipient sells the property, okay, the sales price is greater than the donor's adjusted basis, then the gain is going to be equal to the sales price minus the donor's adjusted basis. If the sales price is between fair market value and the donor's adjusted basis, well, then there's no gain or loss when the recipient sells it. If the recipient sells it for less than fair market value, then the loss is going to be the sales price minus the fair market value of the gifted property. Okay, so we've got a corridor, really. If we look at the situation, we have depreciated property, so the basis is higher than the fair market value. The basis is higher than the fair market value. If the sales price is above the basis, we only recognize the gain amount above the basis. If the sales price is below the fair market value, only the amount below fair market value is a loss. And if the sales price is between fair market value and the donor's adjusted basis, then there's no gain or loss. So here's the example, and we'll kind of go through this a couple of times. Aunt Laura gave a necklace to her niece. The necklace cost Aunt Laura $250 and had a fair market value of $200 when gifted to her niece. So it's gone down in value. She paid $250, it's now worth $200, it's gone down. Because the donor's adjusted basis in the necklace was greater than the fair market value of the property, the niece's basis when she sells the necklace is going to depend on the sales price. So, if the sales price is greater than $250, the gain will be the difference between the sales price and $250. If the sales price is between $200 and $250, no gain or loss. If the sales price is less than $200, the loss is the difference between $200 and the sales price. Okay, now let's put some sales prices in there. If the sales price is $300, the gain is $50. If the sales price is $230, no gain or loss. If the sales price is $180, there's a $20 loss. Okay, so a corridor is created to determine that gain or loss, and if the sales price is within that corridor, there is no gain, there is no loss. Okay, so that is depreciated property. We looked at appreciated property, and kind of the thing there was the gift tax. We looked at depreciated property, and the thing there is that we can't calculate our basis until we later sell it. Okay, so we need to know those. We also need to look at the holding property for gifted property. Okay? When we receive the gift, how long are we considered to have been holding it? Well, that depends on our basis as well. If we use the donor's adjusted basis, then we include the donor's holding period. If we end up using the fair market value at the time of the gift, then our holding period begins on the date of the gift. Okay? So if we use their adjusted basis, we include their holding period. If it ends up being fair market value, then it's going to begin on the date of the gift. And that's ultimately going to determine short-term, long-term, okay, how long it is that we held it. Now, the third situation in terms of acquiring property is when we acquire property by inheritance. Somebody, very possibly a relative, dies, and in their estate, we are given some of their property as part of the inheritance. Okay, it's a gift after death, really, is what it is, but we've acquired property by inheritance. And again, we have the same two questions: what is the basis and what is the holding period? So we start with the basis of the inherited property. Inherited property will have as its basis the fair market value on either, okay, it's fair market value on either the date of death or at an alternative valuation date, which is generally 6 months after the date of death. So we have the date of death or 6 months afterward. Now this alternate date, 6 months later, can be chosen only if it decreases both the value of the gross estate and the estate tax liability. And it's the executor of the estate that's going to make this decision about which valuation date is used. Okay? The date of death or 6 months later. Now, I've got kind of a 6-month window there that's an issue. If that alternative valuation date is elected and the property is distributed or disposed of before that 6-month date, then what's used as the basis is the fair market value on the date of distribution or disposition. Okay, so there's going to be no gain or loss there because the basis is the fair market value. Okay, so it's either the date of death or 6 months later. The executor makes that choice. And we'll look at some examples here that go through this. Our first example, on December 31st, Boris received a car from his mother who died on June 21st. The vehicle had a fair market value on June 21st of $20,000, fair market value on December 21st of $15,000, and the fair market value on December 31st of $14,000. So it's going down. The executor decides not to elect the alternate valuation date. Okay? Now, since the alternate date was not selected, Boris has a basis that's equal to the fair market value on the date of death, which was $20,000. Okay? That's the first example. That alternate date was not selected. Now, the second example is all the same information. $20,000 on June 21st, $15,000 on December 21st, $14,000 on December 31st. Except in this case, the executor decides to elect that alternate valuation date. Well, that alternate valuation date is 6 months later. And 6 months later, on December 21st, the fair market value is $15,000. And that is going to be Boris's basis in the vehicle. Okay, the third example. On November 30th, Boris received a car from his mother who died on June 21st. The vehicle had a fair market value on June 21st of $20,000. The vehicle had a fair market value on December 21st of $15,000. And on November 30th, the car had a value of $18,000. The executor decides not to elect the alternate valuation date. Well, if they don't elect the alternate valuation date, then Boris's basis in the vehicle is still $20,000 because that was the fair market value on the date of death. Okay? Doesn't matter that it was given before the 6 months because the alternate valuation date was not selected. The basis is the fair market value on that date of death. Now, the last example is the same as the third example, except now the executor elects to use that alternate valuation date, okay, which would be December 21st. But again, in this example, the property was distributed on November 30th. And since we chose that alternate date, but the property was distributed between the date of death and that alternate date, we used the fair market value on that date of distribution. Okay, so $18,000 is going to be the basis. The fact that it was $15,000 6 months later, or 6 months after the date of death, doesn't matter. The date that it was distributed became the day that we determine the basis in that property acquired by inheritance. Now, the other question for property acquired by inheritance is holding period. And for inherited property, the holding period is always long-term. Okay, it's just long-term. Doesn't matter when it was received, disposed, and property inherited is long-term holding period. So what we've looked at here is that calculating the basis for gifts or for property that we purchase, property that we receive as a gift, and property that we receive as part of an inheritance. And that basis that we calculated is the original basis for us. Okay, it's our original basis. Now, as we hold that asset, that basis is going to be adjusted, most likely or very possibly. And so that original basis is the starting point. The adjusted basis is what is used to calculate the gain or loss when we finally dispose of that property. The adjusted basis is that original basis, and it's going to be increased if we have any capital expenditures. It's going to be decreased if there's any depreciation, amortization, and depletion charges. Okay, that's our original, and it may go up or down depending on what we do with that asset, how long we hold it, what type of asset it is, and things like that. So our adjusted basis is ultimately what we're going to use to determine the gain or loss on that sale. If the property appreciates over time, our basis isn't adjusted for that appreciation. Okay, which is why we end up with that the giver's original basis goes generation through generation through generation. So somebody somewhere is holding a ring that, due to values and all of that, is worth hundreds of thousands of dollars. But if we were to trace that basis back, it's $10 because 150 years ago they paid $10 for it. Okay, that appreciation isn't an adjustment to our basis. Okay, we have our original basis, then there's going to be adjustments to it, but not for appreciation. So this was the acquisition of the property. What is the basis? How do we calculate the holding period for purchased property, property received as a gift, and property received as an inheritance? There are some details in there, but it's just a matter of keep getting your mind around that gift of appreciated, depreciated property, the valuation date for property received in inheritance. They can't do a lot with these questions, variations on a theme. So once you understand how these bases are calculated, how the holding period is calculated, you're pretty solid for any of the questions that you're going to get about, the basis of property that we acquire by purchase, gift, or inheritance.